Hello and welcome to this stock analysis update for Navitas Petroleum, an Israeli oil development and production company listed on the Tel Aviv Stock Exchange. They are a virtual company headquartered in Herzliya with 25 employees. Before I continue, this is not investment advice, and speak to your qualified financial advisor before making any investment decision. So Navitas began life in 2017, acquiring a small amount of the Buckskin North project, which is based in the Gulf of Mexico. They've also been producing for a while now the Denbury and Neches projects, which are both onshore Texas oil fields. They've actually recently begun production in a extension to Buckskin. And currently we see here the NPV10 values of the Neches, Denbury and Buckskin projects, but it's actually kind of small fry because coming down the pipe very soon is the beginning of production in the Shenandoah project, which, as you can see, is, as Navitas say themselves, a game changer. The Shenandoah project is also in the Gulf of Mexico. Now, in December just gone, Navitas provided an update for the Shenandoah project. You can actually watch this update on YouTube, although it is in Hebrew, but if you use the translator, you can actually get 90% of it. And in this, they announced that they had completed all the production wells. They were just doing some completion testing, and production is expected to begin before the end of the first half this year. To enable that production, they've actually built this floating production and storage vessel, which is very impressive. It's about the size of two Statue of Liberties, so it's an absolutely huge vessel. And this has been built in the Hyundai shipyards in Korea and is currently on its way to the Shenandoah area. They'd also announced an extra 150 million. They've already had about $500 million funding facility with a banking consortium for the Shenandoah project, and they've managed to extend that by 150 million, and that's for two new development drills, which they've called here the Greater Shenandoah resources. Also for a underwater pump. So all of this will increase the production capacity of Shenandoah, as you can see here, in about 2026 onwards, which will accommodate increased production capacity at Shenandoah, plus the additional development work they're doing, plus the Monument project, which is a nearby project that they're going to bring on board. So it's very impressive how they've already got this amazing vessel, FPS vessel, and that by doing nearby developments, they're able to very efficiently return even more revenues from this project. And you can see here the Monument, which has already achieved a final investment decision, and now that with this extra investment they can accommodate that. Plus there's also a Yucatan project which is awaiting FID, but which is also an oil field close to Shenandoah, which they can use this same awesome FPS vessel in order to exploit. So when you see the increase in NPV10 coming from Shenandoah, we can understand why the share price of Navitas has done so well, as investors anticipate the beginning of production at Shenandoah. Some other news was that they achieved a 100 million credit facility with Trafigura at SOFR plus 4.5%. And actually, they only just recently raised $110 million of Series G debentures at a 6% rate. Now, Navitas are actually really bad at updating on their website the latest news releases. And I got that information by my friend on X, Epsilon Tau, who runs this investment website. Make sure you go and check it out and check him out on X. But thanks to him, we had some good discussions on X about Navitas and Rockhopper. And thanks to him, I found out about this very recent new debenture raise by Navitas. Now, of course, what brings me to Navitas in the first place is the Sea Line project. And Navitas have a 65% stake in this project. In the investor update in December, they've confirmed that the FID won't be until the second half of 2025 now. They've been clear that they won't begin Sea Line FID until production started with Shenandoah. And really, my gut feeling is that, you know, these things often tend to happen a bit late as well. So it wouldn't surprise me that we'd have to wait till even 2026 before Sea Line began or the FID was achieved. But based on all the momentum building up at Navitas, which I'm going to cover, it seems fairly likely to me that the FID actually will happen. Something else that came out of the presentation, the Sea Line project is actually the fourth largest discovery in the world that's pre-FID, so that's very interesting. And also in their call, they gave us the interesting information that the actual FPSO identified in for Sea Line is currently based in the North Sea, and they're adapting one in the North Sea to then send it over for use in the Falklands. That's actually going to be a lot quicker than obviously trying to build one from scratch, and makes sense because apparently the North Sea conditions are very similar to the Falkland Island conditions. They also said that technically they consider the Sea Line field is actually a relatively simple oil field for them to work on. And they actually also went into how they were planning to actually acquire additional FPSOs. So as the project developed, once they'd got it going with the initial funding plans and FPSO, they would then start buying additional FPSOs and then start developing actually the southern area as well. There'd be an initial phase in the northern development area where they would do 11 wells, 6 pre-first oil, and then they would do a phase 2, a further 12 wells, and then the central development area, which is also called a phase 1 of 12 wells. Now, this is my own chart I made off the competent persons report. This has probably got some level of error in it, but my rough estimation is that they'll need to raise 1.4 billion before first oil, of which they'll be lending Rockhopper 0.5 billion. I think the overall money that Navitas need to do this is probably something like 4 billion. And although I'm kind of assuming that they'll be raising the 1.4 billion first and then raising more money as you go on later, it kind of wouldn't surprise me if, like they did with Shenandoah, they get together a banking facility that covers the whole thing, and then they eat into that as they need it. But I think my assumption is that they'll need 1.4 billion. And if anyone who's watching thinks they know what their plans are in terms of, will they raise only 2 billion or 1.5 billion, or will they be raising the 4 billion, please let me know in the comments, either on YouTube or on my Twitter account. So this raises the question, really, will they be able to raise that money to enable the final investment decision? So I'm now going to go and take a look at the company's finances, and let's see if that gives us some level of confidence, whether, how well they're doing. We know that the market thinks they're doing very well. So based just on the share price, you'd think, yep, they shouldn't have a problem. But let's try and understand how they work really a bit better to help give me that confidence. So as I've covered, they've started out with these relatively smaller projects, and they've definitely done a very successful job of building them up. We see the revenues go up, but the revenues are actually dropping now in 2024. However, that is in the context that we're expecting massive cash flows to begin coming in for Shenandoah. The revenue should actually start ramping up to some roughly, say, 500,000,000, that kind of number, in the next few years. So we're seeing a bit of a drop off now, but Shenandoah goes into production this year, and so that's you really do see how it's going to be a game changer when we look at the revenues. The finance income is mainly stuff like FX, and we can kind of ignore it because it's kind of a small number anyway. Then on the expenditure side, we have the cost of oil production is actually the main cost, as well as depreciation and depletion. So obviously, as they have more revenues coming in from more projects being online, these costs go up. But currently, it appears like a healthy balance when I look at their operating profit and net income. Now, their general and administrative is very interesting because they appear to be a very efficient company. I think this comes about from them operating like a virtual company with only 25 full-time employees. They contract out people to do all the actual heavy lifting, and they manage it. They're more like a project management company. The benefit of that, when you compare them to a conventional oil and gas company, they're very efficient when you consider their actual general running costs. Exceptionally efficient, actually. However, when I started to dig into their finances a bit, there was something that was a bit odd, and that's these financial expenses. When you dig into the report, and the latest one I have for that is the 2023. What we see is they actually are paying, and obviously we know that they have this tidal wave of debt here. In fact, they have about 1 billion of debt. So what happens is, using 2023 as an example, they actually paid about 26 million on interest on their debentures, plus 24 million on interest on their bank loans. So that's about 50 million of interest they paid, but it doesn't show up on their expenses. And that's because they count it, or they kind of credit it as a capitalized cost. And so actually, in reality, I've got here the interest they're paying. So they actually paid 50 million in 23. Then this is what their net income would be, even though the actual reported net income was a positive 26 million in 2023. If you were to take account of all the interest they're paying on their debt, and also take away financial income they've received, they actually would have made a loss, all stood on their own, of 33 million in 2023. So what is this capitalized cost thing? Well, I asked Grok, and it gave me an answer here, which you can print screen. Here's the initial summary. But essentially, what's happening is that because of a kind of accounting thing, what Navitas are doing is all of the interest that they're paying on their bank loans and debentures, rather than stating that as a finance cost on their expenses, they're actually adding it as an asset, and it's going on this line here on their investments in oil and gas assets, and then depreciating that over the lifetime of the assets, which means that rather than seeing that number come out here when they actually pay the interest, you see it come out in this line, the depreciation line, in the future. So by some weird accounting magic, rather than, even though they spend that interest this year, you don't see it as an expense this year. You see it in future years, over the lifetime of the asset in this depreciation line. And then also it actually gets added as an asset initially as well. This is one of them things where it makes perfect sense to accountants, and that's the right way to do it according to accountants. But to someone who's just trying to have a good understanding of what's going on, that isn't so useful. And so that's why I've created my line here of what's kind of really going on behind all of that accounting kind of jiggery pokery. But what I would say is, although that would kind of look bad at the moment, and they're in 2023, for example, they were paying out 50 million in interest. When you consider that Shenandoah is about to come online this year, and that'll be bringing in about, well over 500 million a year, this kind of negative 33 million real number isn't actually so bad. I'm actually going to drill down into these future cash flows a bit further, but before I do, let's just finish the balance, looking at the balance sheet. So their assets are mostly the long-term assets, which obviously increase as they bring on these new projects into production. And they actually have 119 million of cash and equivalents, which is nice. And then the liabilities, it's kind of mostly dominated by their long-term debt, and they've got 500 million of debentures and 362 million of long-term debt. So roughly a billion of debt. And that debt is what I'm visualizing with this slide as I keep track on Navitas. Okay, so I've worked out that the net income being reported isn't really ideal for a layperson like me who just wants to understand how's the money flowing now. I don't like these abstract accountancy tricks. So let's just double check. Are we good? So what I've got here is the future net revenues before taxes discounted to 10% for all of the Navitas projects. And of course, we've got here the Nietzsche's, Buckskin, and Denbury. Those are all fairly reliable numbers because they're already producing. Shenandoah is reasonably good numbers, but it hasn't started producing yet, so you can't be totally sure. Then, of course, Sea Lion, they've not even started developing yet. But assuming it all goes well, this then gives us this overlay of the expected future net revenues for all of the Navitas projects, and we see that actually, although Nietzsche's, Buckskin, and Denbury are fairly minimal in their contribution, which is what you'd expect actually from the numbers we have here, Shenandoah is actually going to massively increase the revenues they've got coming in, and we're talking about net revenues after costs of over 400 million, for quite a few years. And then Sea Lion overlaid on top of that, you really do see very substantial numbers in the future, with Sea Lion eventually taking off as Shenandoah fades away. So just from these numbers, we see substantial increases from the current revenues. And so this really does explain why the share price has done so well for Navitas, with Shenandoah just about to start production. But as a rock hopper investor, really I'm more interested in their ability to raise debt, and also to consider what debt they're in and how that all works. So What I've got here is the capex spend required for each of the projects. Thanks to the 150 million extension they've achieved for the Shenandoah facility, plus the extra 100 million and 110 million in debentures that they've recently raised, they've easily got Shenandoah covered. So we don't really need to worry about them raising more debt to cover Shenandoah. However, for Sea Line, by my calculations, they are going to have to raise 1.5 billion in order to invest that initial capex. Now, I've actually answered my own question of earlier in the video, because I'm fairly sure they won't need to raise, although Sea Lion will require in investment, in capex investment. When I look at the competent person's report here, we see that obviously the first 3 years of Sea Lion, they're not bringing in any substantial revenues, so they really do need to raise that 1.5 billion to cover these costs here for them, and to also to loan to Rockhopper. But then actually from 2028 onwards, well, the Shenandoah project will easily be completely self-sustainable by then, with any more capex covered by revenues. For Sea Lion, from 2028 onwards, it actually does become sustainable, self-sustainable, because the revenues they'll have coming in cover any required more capital costs as they run through the different phases of that project that I was describing earlier. So the fact is, they're about, let's call it, 1 billion in debt now. They will need to raise 1.5 billion this year to cover these capex costs for Sea Line. So what I've done is I've put here the debt that I see them having. I've then calculated what is the interest on that debt going to be. Now, it will be a bit less than this, but I've assumed 10% interest. It's important that I'm deliberately harsh here, because any error is against my advantage, if you know what I mean, so that I can come up with a sound decision. And so I'm being a bit harsh there, but call it, just to be really in the safe, really to give myself a big safety margin here, called it 10% interest. It's probably more like 6 or 7%. What I've done in this column is I've got their expected revenues, the expected net revenues, and then I've took away the interest of that. I've taken away from that the interest on the debt, and then also I've taken away 50 million. They've currently got general admin running costs of about 14 million. So again, let's be extra safe and call it a 50 million cost. So then that gives me a revenue minus the interest on the debt, minus 50 million general running costs every year, giving lots of leeway for, a couple of things going wrong here and there. And then that allows me to work out how much of that debt will they be able to pay off in any given year. And so from this, I've calculated, here's this same chart, but I've basically overlaid onto that the debt that I see them having. And here we see that within 10 years, they should be able to pay off all that debt if they don't invest in any other future follow-on projects. And there is actually quite substantial incomes coming in after they've paid off all the debt, a good 500 million for a few years, versus their current net assets of 500 million, and versus like the kind of revenues they're bringing in now. If Shenandoah and Sea Line are both successful, we can see this company being in a very healthy situation, in 10 years' time. However, you've got to realize that there's a lot of debt here they've got to take on to achieve that. And then this is kind of then how I get to really understand how Navitas work as a company. We know from looking at their accounts that they are a very nimble project management company that just take on debt and then outsource the work to to operate these projects using debt. And this is why they have a tidal wave of debt, and really the lifeblood of this company is the fact that perhaps particularly with the Israeli debt markets and banking system, there are actually a lot of investors and banks in Israel primarily, but also in the US, who are very eager to lend Navitas money for the large interest they'll receive on their investments. Plus, a lot of these investments are actually collateralized, so they're kind of getting lots of upside here with maybe minimal downside on that when you consider that. And then this is kind of how you can understand this company. What enables this whole situation to exist really is this eager debt market. There's lots of lenders willing to lend to Navitas and perhaps other companies like them. This explains this profile here, which kind of looks onerous, to be honest. If things go wrong for shareholders, it looks kind of actually fairly onerous. But it works for the lenders. This provides to me a kind of understanding of how it works. The company has, through this strategy, got a tremendous track record. Over many years, they've started off smaller, developed, once they got the production, got more debt, some of it collateralized on this production, to then invest in more. They then pulled off this huge $500 million facility for Shenandoah. They got Shenandoah going and been very successful there. So now they raise more debt and move on to Sea Line. There's an excellent track record. It's a very competent management team. And, it really is very impressive what they've achieved. But ultimately, it's all about there being this ready market of people willing to buy bonds and lend money to them. When I look at it in that context, I could definitely see them, for example, raising 0.7 billions worth of debentures collateralized against the Shenandoah project, and then also raising like a 0.7 billion banking facility on top of that, which they can access as the project progresses. Based on the past history, what we see, and this sign of an eager bond market in Israel, I can really see them pulling that off, really, assuming it was collateralized against Shenandoah. Why wouldn't the bondholders lend them the money for a 6% return, say, if it's collateralized against all these future returns from Shenandoah, just in case Sea Line went wrong? Plus, just add to that the amazing momentum and track record of this company, which is reflected in the share price. My kind of intuition here, and that's all it is just my intuition, is that yes, based on this information, they can raise the debt. And as a Rockhopper shareholder, that's great, because I kind of feel like they are going to be able to raise the debt. There are going to be people wanting to buy bonds on those terms. And then Rockhopper will get that final investment decision, which is what I need for my exit strategy on Rockhopper. So as a Rockhopper shareholder, I'm fairly pleased with how everything kind of checks out here. As a Navitas shareholder, I wouldn't be so eager. Navitas shareholders have enjoyed a 4x gain here. However, you're kind of entering a new risky phase where they're going to have to take on. So actually, here's how it looks in this case, I've taken out the Sea Line. What would happen if it was just the Shenandoah in a great position? And it's kind of, there's no risk, actually. There's very, minimal risk now. But in order to develop another project, they have to raise debt, and then all of a sudden it's a lot more riskier an appearance to me as a shareholder. So Navitas shareholders have to realize this isn't a fairy tale. Navitas have to do a very difficult job of developing the Sea Lion project in order to get to this point again in 10 years' time, which is kind of like a follow on of where they are now, having got Shenandoah on the road, but before they take the next risk. So, yeah, for Shenandoah shareholders, it's not really my risk appetite, actually. Risk here and a lot of debt. I can see why people are staying invested in Navitas because they've got such a tremendous track record. But if it was me and I'd achieved a 4x here, I would actually probably be, certainly selling half or maybe three quarters in appreciation that they're now in a heightened risk phase. That's just me. That's just my very kind of generally more risk averse approach. And everyone has to make their own decision. Now, I'll also say that these calculations I've done are very rough, very back of a fag packet, but as a Rockhopper shareholder, I've certainly, I think, done enough to understand how this company works and make myself safe in my mind that when you look at the current situation of the company, I've been able to understand how they tick in terms of their balance sheet here and their profit and loss statement, and in a very approximate way, assuming that Shenandoah is successful and then Sea Lion successful flowing it, I've got a very good approximate idea here of that they will be able to pay off their debts in a reasonable time frame. I can kind of see how they'll be able to raise the money for the Sea Lion FID, based on how they operate and based on the fact that they'll then have Shenandoah up and going, which they can use actually as collateral if they need to help raise that 1.4 billion of debt for Sea Lion. I think I'll end it there. It's been a very useful exercise for me. It does actually give me a bit more confidence rather than less that Rockhopper will get an FID, and look forward to hearing back to people's comments. So good luck with your own investments and speak to you at the next video. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.